Hi, I'm Keith McCullough. Welcome back to our beautiful new studio here in Connecticut. I'm here to talk to you about another global macro theme. And again, our global macro themes, for those of you who don't know, we introduce every quarter. We introduce 3 different macro themes, and this one is going to be called debt deflation. Let's get started. So what is debt deflation? First of all, we made up the word. We like to make things up at Hedgeye. Central planners make stuff up all the time. It's fine. We also called it commodity deflation about a year ago when we got bearish on commodities. So again, commodity deflation, we think gold, et cetera, is going down. Debt deflation, same thing, but with bonds. We think the value of bonds or the price of bonds is going down. So let's look at the first chart in terms of how we decided to break this down. The first chart is basically pie chart of what we think is global capital stocks. So there's debt and there's equity. And at the end of the day, there's a lot more debt than there is equity. There's, in fact, 3 times more debt than there is equity. And not only is that the highest percentage ever, but it also shows you the scarcity value of equities. So that's one of the main reasons why we like equities, because a lot of this debt needs to flow into the equity part of the chart, and the equity piece of the chart starts to get bigger as the debt part deflates. So again, that's why we think about it that way. Again, debt deflation is basically reducing the size of the debt in this chart. There's a ton of sovereign debt in this chart, which we're going to get into, and we're also going to get into the flows. But first, let's just look at the U.S. side of the equation. So if you look at this chart, what we're going through here is outstanding debt in the U.S. bond market. What you'll quickly note is that the green line is the hottest line. So this is, Ben Bernanke's buddy. Since 2006, when he took over at the Fed, of course, all he did was print money. So in fact, that line has gone straight up. In fact, it's gone from $4 trillion to almost $12 trillion. So what we don't want to do is buy that green line, because that green line can deflate. Again, it's epic proportions relative to anything else that it's ever been as a percentage of anything else, or as a percentage of that piece of the pie that I was just looking at. Now, again, if you want to look at this in terms of how it flows, let's look at this next bar chart. Now, this bar chart shows you fund flows. And for June, this is basically all that happened. People said, get me out of fixed income, get me out of commodities, and, oh, I'm going to buy stocks. Now, not everybody bought stocks, and I think that this is one of the main reasons why the bears have been wrong on the U.S. stock market for the year to date. They didn't understand the flow show, or at least the flows of this game. So again, if bonds are going down, emerging markets are going down, you run out of places to park your money, and one of the great places to park your money has been, and I think will continue to be, the U.S. equity market. Now, in terms of Treasuries, just going back to levels, of course, what would stop me out or get me out of this position? Again, I always go back to the playbook. I use our quantitative process. And our quantitative process says that, again, looking at this from a TLT perspective, we're using that as a proxy for long-term bonds. Unless you get above my intermediate-term trend line, which is 3 months or more, or my long-term tail line, which is 3 years or less, then I'm not going to get out of the short bond trade. Resistance is overhead, and I have nothing but downside in this type of a security from here. So again, it's a fairly straightforward thesis that is matched up with the fundamentals. Now, people will say, hey, you don't like bonds, then you don't like all my bonds? I mean, I run a bond fund. Well, that's too bad. I mean, I don't run a bond fund. And again, the reality is that you don't have to own bonds. But as we look across all these different ETFs in bond land, they're all breaking down from a trend perspective. Now, that's just our Hedgeye risk management quantitative view of it. But again, it's a pretty successful view if you look at the track record of what we've been doing over the years. And if you look at the HYG, which is, of course, the high yield ETF that we have here on this chart, the trend line of resistance is 92.31. So provided that the price of those bonds is below that, you're either selling your long position or you're looking to short it. There's a lot of ways to win with this debt deflation thesis. Now, I'd be remiss not to finish with the mother of all sovereign bond bubbles, which is, of course, Japan. Now, the 10-year bond yield in Japan is at 0.8%, okay? 0.8% for a long-term bond. That could double, no problem. As you can see in this chart, very straightforward. This thing has been the mother of all bubbles. It started in 1997 when Paul Krugman, who's Ben Bernanke's Princeton buddy, decided to tell the Japanese, print lots of money. So they tried that, it didn't work, and then they're going to do it again and again and again. And the reality is that if the Japanese actually get what they want, which is either growth and or inflation, or try to confuse their people that inflation is growth, guess what bond yields are going to do in Japan? They're going to go up. So again, the bond yields that could go up here in the US or in Japan could be epic. And again, that's not what you want to be investing in. What you want to be doing when you have debt deflation as your view is getting out of the way. So to review debt deflation, 3 things. Number 1, sell Treasury bonds. Number 2, sell Japanese government bonds. God forbid you own any of those. And number 3, buy U.S. growth stocks, which continues to be the least obvious thing for at least consensus to do. If you have any questions on this, would love to hear from you. At Keith McCullough is, of course, my Twitter handle. And then at Hedgeye TV, we're really excited to get your feedback there as well. Thanks for joining in.